Folks, on this channel, we are so lucky to bring experts with a wide range of experience. Our Monday guest, Taylor from Life Goal Investments, was a 10-year veteran of Wall Street. So what I want to do with a Wall Street veteran is talk about a stock market crash. I'm going to ask him to put some numbers on it, and we are going to relive some crashes from the past and talk about what might be an earnings recession, maybe a crash, maybe a correction coming. But Taylor, how you doing, man?
I'm doing great. This is an exciting topic because I think a lot of people are rightfully scared about a potential crash coming in the stock market.
So let's put some numbers on this first. Let's talk about a correction and then a crash so we can at least start that definition. What would you call a correction? And then what would you call a crash in the stock market?
Yep. Technical definition of a correction is a 10% drawdown from the peak. So we've obviously experienced that thus far. The next step is a bear market. A bear market is a 20% drop from that peak. And then a crash, admittedly, a crash really doesn't have a true definition. But if you were to throw me under the bus and say, hey, Taylor, tell us what a crash is. A crash is maybe when the market loses a third of its value from its peak. And I think what realistically the crash is more of the sentiment than it is anything else. When you a hyper fast drawdown and all conviction in the market is lost seemingly overnight, and this feedback loop of selling begetting more selling drives the market down further, that's what I would call a real systematic crash in the stock market.
If you were going to look at one metric, and I know there are many that would kind of highlight a crash is happening, would that be the VIX? Is that kind of the indicator for stress in the market? It would spike?
Yeah, that's a really good indicator. So generally there's a negative correlation between VIX and the stock market. So the VIX is often known as the fear gauge, right? So as fear goes up, the VIX moves up. And generally what happens when the VIX is moving up is stock market is getting a crash on the other side, is coming down meaningfully. So again, that negative correlation between the two. And then when the VIX starts to depress downwards, that's when you start to get some calms in the market. And generally calms in the market come with a slow drift higher in the stock market. So to your point, historically, when we've gotten really crashed in the market, you've gotten a massive leap up in the VIX very quickly. If you get a 40 or a 50 handle, if you get to a 60 handle on the VIX, that is when you have that hyper tension in the market. Normal, for context, is about 20. And what you'll see is generally a move higher very quickly, and then you'll have it settle in very slowly as things start to get digested and people start to realize maybe we've overcooked this sell-off in the short term.
Okay. What I want to do is talk about some crashes from the past that I've experienced in my adulthood. Some of these were when I was a teenager. But again, we've probably both looked at them. And I think we got to start with Black Monday, which was 1987. Something happened on Black Monday that will never happen again because they put in circuit breakers. But let's just talk about how bloody Black Monday was from your memory, and then talk about what was put in place after that so it never happens again.
So I will, whatever the opposite of aging myself is, I was not around during Black Monday. So I'm an 88 kid. I was born in 88. This was October 20th, I want to say, of 1987. And in one single day, you had a 20% correction. I think 21 or 22 to be precise. 20% drawdown in the stock market in one single day. It was absolutely brutal. And people just didn't know what to make of it. There wasn't a real cause to it. There wasn't something where you can go, this is what caused it. Something blew up, a bank failed, whatever it may be. There wasn't any big cause to it. And that was what caused so much fear afterwards, was to say, what has, this not happening again next week or the week after, because there's nothing we can point to say, this is what caused the thing to blow up.
Yeah. And what I really want to highlight for folks is that will never happen again.
Correct.
We will never see a 20% crash in a day again, because I call them circuit breakers. I don't know what the financial term is.
I think that might even be the technical term, circuit breakers.
Ah, there you go. So we have some circuit breakers. I believe there are 3. One is it 5% at the index, 5%? Then 10, and then
there might be one beneath that as well, but 5% essentially you hit the pause button.
Right, for like
any
an
stock
hour.
Moving downward quickly at 5%, or I'm sorry, the stock market moving
index,
downward at 5%, the index, you hit the pause button. And then at 10%, it's a longer pause. And then I do think that there is some really visceral.
Yeah, there's a third one that's like, we're closed for the day.
Close for the day. Exactly right. Yeah. So I'm pretty
Yeah.
sure you're correct that there's 3 systematic things that we can hit. And the last one is we're done for the day. You guys
Yeah,
don't,
we're,
you
go
children
home.
aren't allowed to play.
Yeah, we're gonna go figure this out because something's going on and the machines have taken over.
Correct. And that's a good point
yeah.
though. What I'll say on your note there is um when you talk about machine trading,
Yes.
algorithmic trading, so what it can do is create this negative feedback loop where all of a sudden there are rules in place in these big institutional funds that says, hey, if we get a correction of 5%, that trips our sell. And then that can trip the next sell, and then that can
Right.
trip the next sell, and it just goes. And
Yeah.
that's why we
And
need
it's
these
just
circuit breakers in place. Yes, it can
yeah.
happen very, very, very quickly.
Yeah. So again, kind of then we can talk about what I'll call the .com crash. And again, this is probably NASDAQ oriented, but
Yep.
peak to trough, the NASDAQ was down, I believe it was 81%, but that
Brutal.
wasn't a single day like 1987. It was like 2.5 years or something.
Yep.
It was a long death by 1,000 cuts. Again, certainly a crash, but not very opposite of the 87 crash.
Correct. It was just so stocks, specifically .com type stocks, had a real big movement downwards. And then everyone's like, okay, maybe we're settling in here, getting a bottoming point. And then what happened for 3 years?
Oh.
2000, 2001, 2002, it just kept going down. And you'd get a bear market rally and then it'd sell off again. And you'd get a bear market rally and it would sell off again. And it was just this stomach churning process that seemed to never end. And it made a lot of people become non-investors for the rest of their life, which is obviously, there you go. There you go. Explain. Yeah, give us your take on this.
No, I mean that was the environment I lived through. Again, the stock that I was trading was Cisco Systems for the majority of it. Uh, Near as I can tell, I haven't looked today, but it hasn't gone back to its high in 20 years.
20
And I think there's a
years.
couple of stocks today that will never see their high for 20 plus years. And
I
they
agree.
are they're the cult stocks. Cisco, what people don't understand is we have cult stocks today, just like Cisco was the internet.
Yep.
It was the internet. It was the thing. And there were points in time in that cycle where we have not gotten back. If you are holding on to Cisco, you have dead money for 20 years. Can you
That
imagine
is
dead money?
so hard. That is so hard because listen, like here's a really good rule of understanding how quickly your money doubles. So what it is, it's called the rule of 72. You've heard of this. So you take 72 and you divide it by whatever the rate of return is that you've experienced. So a normal rate of return is maybe call it 8%. So 72
Sure.
divided by 8, your money should double every 9 years. This is Michael talking about zero gain over 20 years. You should double 2 times in that period of time and you've gotten zero return.
Yeah. So there's some dead money sitting on people's portfolios because, hey, I bought X, Y, or Z company at some price and it's down 30%, but I'm going to wait to get to even. Even could be a long way away.
Yeah. The whole notion of the fact that if you lose 25% in the stock, you need to get 33% back. If you lose 50% in the stock, you need to get 100% back. Like that is something that's so important. And that's why we preach diversification ad nauseum, because listen, diversification causes you to lose less money. How do rich people get rich? They don't lose. They don't lose as much, right? And so that causes them to not have to gain as much. And their upside isn't going to be the hyper upside that maybe a retail investor saw in 2021. But guess what? They're not down 39%, which is what the average retail investor was down in 2022. That's a JP Morgan stat.
Wow.
39.
Wow. So let's talk about where the market is today, because again, I think we've left the good times. I think we're on the cusp, if not the recession has already started, which I've called. That could lead to an earnings recession. We could have multiples compression again. I think multiples actually expanded over the last 3 months, which is wild.
They did.
So if you get multiple contraction plus earnings coming in, that could lead to, something greater than a correction for sure.
Listen, guys, like it's weird to say that the price to earnings multiple, that's essentially how much you pay for every dollar worth of earnings. So when earnings are expected to contract, generally the price to earnings multiple contracts prior to that. We're getting price to earnings expansion right now. It doesn't make any sense. We're trading at 18.5 times in the S&P 500. Normal is about 16 times, and recessionary numbers are around 12 times. So
Yeah.
guys, that says just in the price to earnings multiple, without the earnings contraction that you can experience from 18 to 12, guess what, guys? That's a third. That's the 33% decline that could be experienced just on earnings without the earning contraction coming along with it. It's
Yeah,
funny, the stock market right now and the bond and the gold market are saying diametrically different things. The stock market's saying, hey, we're going to have a soft landing. We're going to be able to avoid this with this banking thing going on the side. Whereas on the other side, the 10-year treasury last week was down 21 basis points. It's down 69 basis points over the last month. That is saying we're going into recession. Gold, by the way, one of the ultimate fear trades, is up 10% this year. We're seeing stocks go up simultaneously, which should have an inverse correlation. Treasuries are rallying massively, saying that we are in a real economic slowdown. Gold saying the same thing.
Well, I think it was JP Morgan. It might have been actually Morgan Stanley kind of highlighted. I think it was 2 weeks ago that the individual investor has been trained to buy the dip. And they bought the dip at record numbers, something like $1.5 billion. It was the average contribution, the last.
$1.5 billion was the contribution per day by retail
day.
investors in January.
That's
Day
crazy.
in January. So that is, it's tough. It's
Hey,
tough.
it worked. You got to admit it worked. Hey, they're up.
It's worked in the short term. I'm not sure it's going to work over the intermediate term.
Hey, let's give them credit. They bought into it.
Fair.
Take some chips off the table.
You know what the 4 biggest stocks they bought were?
Oh God, let me guess. Apple.
Well, actually, let me do them in order because this is the order that it was. Number 1, Tesla, trading at 47 times PE.
Well, let's just talk about Tesla real quick because I don't know if you saw it this morning. PC sales are down. Apple specifically down 40%. I actually talked about it in my daily financial news without naming Tesla. I was like, hey, might there be another company with highly discretionary income tied to white collar jobs that might be getting scared with a high multiple? Might that be a problem?
That's up 80% this year. That now it's trading at 48. It's actually 48 times earnings right now. So
and they just had a price cut.
And they just had a price cut. Yeah. So that's going to drive margins, right?
That's going to have to help margins. Yeah.
Yeah. So Tesla's number 1. Number 2 is Apple, trading at 28 times earnings. Again, the S&P 500 is trading at 18. So that's not absurd. But listen, this is discretionary spending as well. Do I need the next iPhone? I probably don't. In good times, I might buy it, but in bad times, I'm not going to. The third, Nvidia, which is up almost 100% this year, also trading at 60 times earnings. And the last one is Amazon, trading at 60 times earnings. Guys, these are all extremely economically sensitive companies we're talking about here.
Yeah. One of these companies is going to have a pre-announcement and it's going to wreck the whole trade.
So listen, Nvidia is a little different. So if you look at Tesla, discretionary money, no doubt about it. Apple, discretionary money. Amazon, discretionary money for the most part. Some people will argue that people buy necessities on Amazon, and there's some of that. But moreover, it's discretionary spending. And Nvidia is a little bit of a different animal. But if AI doesn't take over the planet, this thing can't trade at 60 times earnings.
Yeah, it's going to be wild. You should just see Samsung, Micron, reduce chips, all of that. So again, demand is down for some stuff. We'll see. It's going to be a wild time. Again, I don't have a great feeling about the year, economic or stocks, but that's okay.
You got me all fired up. I don't know. You got me all hot and bothered today on vacation. What the heck am I doing?
Well, you're going to create some more fire content on Instagram today. I am positive of that. You're going to show us your vacation, I'm sure. Where can people follow you? Because you put out some great stuff.
Yeah, follow us at Life Goal Investments. Life Goal Investments. We got a blue check on Instagram. We're on TikTok as well. Lots of fake accounts out there. So Life Goal Investments, plural.
Investments with the blue check. Thanks, buddy.
You're the man.